The largest single-day loss in modern market history did not happen during a war, a recession, or a financial crisis. It happened quietly, triggered by something far more unsettling. In less than 24 hours, nearly $600 billion in market value evaporated from a single company. Not because demand collapsed, not because earnings disappointed, but because a fundamental assumption broke. For years, investors believed that American dominance in artificial intelligence was unassailable, too expensive to replicate, too complex to challenge, too dependent on capital, hardware, and infrastructure that only a handful of U.S. companies could afford. That belief collapsed in one trading session. The shock did not come from Washington or Wall Street. It came from outside the system that was supposed to control the future of AI. When markets opened, the reaction looked irrational. A historic sell-off triggered by a company most investors had barely heard of days earlier. Analysts rushed to frame it as volatility, as overreaction, as a temporary repricing. But markets do not erase hundreds of billions of dollars without reason. They do it when a story stops making sense. The story that stopped working was simple. Artificial intelligence is expensive, and whoever spends the most wins. That narrative justified trillion-dollar valuations, massive data center expansions, and an arms race for computing power. Investors were told that scale was the moat, that capital intensity was protection, that no outsider could catch up without access to the same hardware, the same chips, the same infrastructure. Then, a small Chinese AI startup released a model that performed at the same level as the most celebrated American systems, at a fraction of the cost. That single fact shattered the narrative. This was not about one company losing value. It was about an entire investment thesis being questioned in real time. If world-class AI can be built cheaply, then the foundation of America's AI dominance looks far less solid than advertised. The implications spread instantly. NVIDIA was only the epicenter. Across the market, anything tied to the assumption of ever-increasing compute demand collapsed. Cloud infrastructure, data centers, AI tooling. The sell-off was not emotional, it was mathematical. If efficiency replaces scale, then much of the existing build-out becomes excess. What made this moment especially dangerous was timing. It did not unfold gradually. It happened over a weekend, while markets were closed, while assumptions had no time to adjust. By the time Wall Street reacted, the damage was already priced in. This was not a correction. It was a reassessment. For years, American tech leadership rested on a belief in inevitability, that more money, more chips, and more servers would always translate into superior outcomes. That belief shaped corporate strategy, government policy, and national security thinking. Export controls were designed around it. Sanctions were justified by it. Investors poured capital into it. The shock exposed how fragile that belief had become. This is why comparisons to past technological turning points began circulating almost immediately. Not because history repeats perfectly, but because power always reacts the same way when its advantage is questioned. First comes disbelief, then comes denial, then comes urgency. Markets skipped the first two stages and went straight to the third. Inside boardrooms, the conversation changed overnight. The question was no longer how fast AI demand would grow. It was whether the entire cost structure of AI had been misunderstood, whether American firms had optimized for scale instead of efficiency, whether spending had replaced engineering. This is the moment when dominance starts to crack. Not when a competitor becomes stronger, but when the leader realizes its assumptions were wrong. And that is why this event matters far beyond one stock or one model. It signals a shift in how technological power is created, defended, and ultimately lost. The shock was not the loss itself. The shock was what it revealed. To understand why the shock was so violent, you have to understand the illusion that came before it. For nearly a decade, American dominance in artificial intelligence rested on a single assumption: control the inputs, and you control the future. Chips, cloud infrastructure, capital, talent. Whoever owned those levers would inevitably win. That assumption shaped everything: corporate strategy, government policy, national security doctrine. Export controls were built around it. Sanctions were justified by it. Wall Street repeated it until it sounded like physics. Artificial intelligence was framed as an industry where only scale mattered, and scale required American money and American hardware. But that belief confused control with inevitability. The United States spent years telling itself and the world that without access to advanced American semiconductors, no country could compete at the frontier of AI. Restrictions on chip exports to China were designed to freeze the competitive landscape in place. The logic was simple: deny resources, slow progress, preserve dominance. What that logic ignored was history. Constraints do not always weaken competitors. Sometimes they force them to change the game entirely. When resources are limited, efficiency becomes survival. When scale is unavailable, design becomes everything. This is not a new pattern. It has repeated across industries, technologies, and empires. American AI companies did not operate under constraint. They operated under abundance: unlimited capital, unlimited compute, unlimited infrastructure. Over time, that abundance reshaped incentives. Instead of optimizing systems, firms optimized fundraising. Instead of competing on efficiency, they competed on valuation. Engineering discipline slowly gave way to financial momentum. The result was an industry built around excess. Data centers multiplied, hardware orders ballooned, energy consumption soared. Investors were told that this was the unavoidable cost of progress. Bigger models required more power. Better performance required more spending. Efficiency was treated as secondary, almost irrelevant. Then that assumption collapsed. When a smaller competitor demonstrated that comparable performance could be achieved with dramatically fewer resources, the illusion broke. Not because American companies suddenly became incompetent, but because their strategy had drifted. They had optimized for scale in a world that was about to reward precision. This is where sanctions quietly backfired. By cutting off access to the most advanced hardware, the United States assumed it was freezing Chinese innovation. Instead, it concentrated it. Engineers who could no longer rely on brute force had to rethink architecture, training methods, and optimization techniques. Every inefficiency mattered. Every wasted computation was a liability. Meanwhile, American firms continued scaling upward, confident that money would always compensate for inefficiency. That confidence became complacency. The illusion was not that American AI was bad, it was that it was unchallengeable. And unchallengeable systems rarely improve at the pace they think they do. This is the danger of monopolistic thinking in technology. When competition is perceived as impossible, innovation slows, complexity grows, costs rise. Eventually, someone approaches the problem from a different angle and collapses the entire cost structure. That is what markets reacted to. Investors were not panicking over one model or one release. They were recalculating the future. If AI performance is no longer tightly coupled to spending, then the justification for massive infrastructure build-outs weakens. If efficiency can replace scale, then the moat disappears. This realization triggered a deeper fear. Not that American companies would lose tomorrow, but that their long-term advantage was thinner than believed. That the gap between dominance and vulnerability was narrower than advertised. The illusion had held everything together. Once it cracked, the reaction was inevitable. And this is why the event was never just about technology. It was about strategy, about whether controlling resources is the same as controlling outcomes, about whether money can permanently substitute for ingenuity. In the next phase, the focus shifts from illusion to consequence. Because when a dominant system realizes it misread the rules, it does not adjust calmly. It scrambles. That scramble is already underway. Once the illusion collapsed, the reaction was immediate but uneven. Publicly, the narrative shifted toward reassurance. Analysts spoke of healthy competition, of innovation cycles, of markets overreacting. Privately, the tone was very different. Inside major American technology firms, the conversation was no longer about growth. It was about survival. This is what happens when a monopoly realizes it may no longer be one. For years, the American AI ecosystem functioned as a closed loop. Capital flowed in, infrastructure expanded, valuations climbed, and each success reinforced the belief that leadership was permanent. That loop depended on a critical assumption. No credible alternative could emerge outside the system that controlled the hardware, the cloud, and the capital. Once that assumption failed, everything downstream became uncertain. Inside Silicon Valley, engineering teams were forced to confront uncomfortable questions. Had they optimized for performance or for presentation? Had they built systems that were genuinely superior or simply more expensive? Had they confused scale with inevitability? These questions do not appear in press releases, but they dominate internal discussions when confidence breaks. The response followed a familiar pattern: emergency reviews, internal task forces, strategy resets. Companies began dissecting how comparable performance could be achieved with fewer resources, not to copy a specific model, but to understand whether their own approach had become structurally inefficient. This moment matters because it exposes a deeper vulnerability. American AI dominance was never just technological. It was psychological. Investors, partners, and governments believed in it. That belief reduced scrutiny. It allowed inefficiencies to grow unnoticed. Once belief weakens, scrutiny returns. At the same time, the geopolitical implications became impossible to ignore. Artificial intelligence is not just a commercial technology. It underpins military planning, intelligence analysis, surveillance systems, logistics, and cyber operations. For years, the United States leveraged its technological lead as a strategic tool. Export controls, alliances, and standards were built around the assumption that access to advanced AI flowed through American systems. The emergence of credible alternatives challenges that leverage. If advanced AI can be built without relying on American hardware or infrastructure, then technological control becomes harder to enforce. Influence shifts from ownership to adoption. Countries begin asking different questions, not who controls the most powerful systems, but who offers the most efficient, accessible, and adaptable ones. This is where the comparison to past technological turning points becomes relevant. Not because history repeats exactly, but because power reacts predictably when its advantage narrows. The initial instinct is escalation. More spending, more restrictions, more effort to reassert control. But escalation often accelerates fragmentation. As American firms double down on capital-intensive strategies, others pursue efficiency-first models. Two paths emerge, one driven by scale, the other by optimization. Over time, the second path becomes more attractive to countries and companies that cannot afford trillion-dollar infrastructure commitments. This is how standards shift. Once efficiency becomes the benchmark, the market expands beyond the original gatekeepers. Innovation decentralizes. The monopoly dissolves not through collapse, but through irrelevance. It becomes one option among many rather than the default. This does not mean American companies disappear. Far from it. But it does mean they lose the ability to dictate terms unilaterally. Competition returns in a form they are no longer used to facing. The most revealing signal is not stock prices. It is behavior. Firms that once focused on narrative now focus on architecture. Companies that sold inevitability now emphasize adaptability. The language changes because the environment has changed. This is the phase where dominance ends quietly. Not with a single failure, not with a single competitor, but with the realization that control has limits. The monopoly does not fall apart overnight. It fractures, and once fractured, it never fully reassembles. In the final phase, the question is no longer whether American AI leadership is challenged. That is already clear. The question is whether it can reinvent itself fast enough to remain relevant in a world where efficiency matters more than excess. That question leads directly to what comes next. What we are witnessing now is not the collapse of American technology. It is the end of American technological certainty. And those two things are very different. For decades, the United States operated from a position of assumed inevitability, not just in artificial intelligence, but across critical technologies. The belief was simple. Leadership, once achieved, could be preserved through scale, capital, and control. That belief shaped corporate behavior, government policy, and investor expectations. It worked, until it didn't. This moment marks a structural transition. Artificial intelligence is entering a multipolar phase. Not one where a single country or ecosystem sets the rules, but one where multiple approaches coexist, compete, and evolve simultaneously. Efficiency-based models do not replace scale-based systems overnight, but they undermine the logic that justified monopoly power in the first place. Once that logic breaks, the system never returns to its previous state. For investors, this changes how value is created. Massive capital expenditure is no longer a guarantee of advantage. Infrastructure-heavy strategies face a new question. Are they building capability or accumulating cost? Markets will increasingly reward adaptability over size, discipline over excess. For corporations, the message is sharper. Innovation can no longer be purchased indefinitely. It must be engineered. Efficiency is no longer a secondary metric. It is the battlefield itself. Companies that fail to redesign their systems around this reality will survive only as long as capital remains patient. History suggests it rarely does. For governments, the implications are even more profound. Technological leadership has been a cornerstone of geopolitical influence. Control over standards, supply chains, and platforms allowed power to be exercised quietly but effectively. That leverage weakens when alternatives become viable. When countries can access advanced capabilities without aligning politically or economically with a single hub, influence fragments. This does not produce chaos. It produces choice. Choice shifts bargaining power. It changes alliance dynamics. It forces countries to compete on trust, reliability, and stability rather than dominance. In that environment, unpredictability becomes a liability rather than an advantage. This is why efficiency-driven innovation is so destabilizing. It spreads faster. It lowers barriers. It empowers actors that were previously excluded by cost alone. Once that process begins, it accelerates independently of intention. The most dangerous mistake at this stage would be denial. Trying to preserve dominance through restriction rather than reinvention has failed before. It tends to harden competitors, not weaken them. Systems adapt. Talent adapts. Markets adapt. Pressure reshapes behavior in ways that cannot be reversed with policy alone. What comes next is not decline. It is competition. American companies still possess immense advantages: talent, capital, institutional depth, and global reach. But those advantages only matter if they are aligned with the realities of the new environment. Efficiency must replace excess. Engineering must replace narrative. Substance must replace valuation theater. The era of unquestioned technological supremacy is over. What replaces it will be decided not by who spends the most, but by who learns the fastest. Artificial intelligence will not be dominated by one flag, one company, or one ideology. It will evolve through friction, rivalry, and adaptation. That world is less comfortable for monopolies, but healthier for innovation. And this is the final fault line. Not between countries, not between companies, but between systems that adapt and systems that assume they no longer need to. In moments like this, power does not vanish. It moves. The only question is who understands that fast enough to follow it.